lucky people. Nonfiction books on TV. Book TV on C-SPAN 2. All books, all weekend, every weekend.
Next, Securities and Exchange Commission Chairman Arthur Levitt. Earlier this week, he announced new disclosure regulations for the corporate bond market. The speech took place at the Media Studies Center in New York and lasts about 30 minutes.
Well, good morning and welcome to this breaking news breakfast with Arthur Levitt, Chairman of the Securities and Exchange Commission. I'm Bob Giles, Senior Vice President of the Freedom Forum and Executive Director of the Media Studies Center. The Freedom Forum is the world's largest foundation devoted to free press, free speech, and free spirit for all people. The Freedom Forum funds a number of operating programs around the world, including the Media Studies Center here in New York City, where we engage the public and the press in a serious examination of news issues and news media performance. We're especially pleased this morning to have Chairman Levitt with us. He will announce a new set of SEC initiatives to increase transparency, the free flow of information to the public about corporate securities markets. Chairman Levitt has had a distinguished career in the financial services industry, including chairmanship of the American Stock Exchange. He is the 25th chairman of the Securities and Exchange Commission. He was first appointed in 1993 and is now in his second term. The chairman has an equally impressive record in journalism and publishing. He was editor-in-chief of his high school newspaper, The Polygon, at Brooklyn Poly Prep. His first job after graduation from Williams College was as drama critic for the Berkshire Eagle. He spent 5 years in marketing at Time Inc. before moving to Kansas City for Oppenheimer Industries. In the 1980s, after working in Washington as a lobbyist, the chairman hearkened to the call of his early love of journalism. And after unsuccessful bids to buy the Daily News and the Village Voice and the New Republic, he acquired Roll Call, then an offbeat Capitol Hill newspaper. The chairman assembled an experienced team that reshaped the content into an entertaining mix of serious journalism, personality profiles, and offbeat stories. And he turned that $500,000 investment into an eye-popping return. The Economist paid a reported $15 million for Roll Call. And so we are particularly honored this morning to welcome Chairman Levitt here as one who possesses a rare combination of backgrounds that enables him to speak with special insight about the role of journalists in the news media in helping the SEC foster the transparency necessary to ensure investor confidence in our markets. Arthur Levitt, please.
Thank you very much, Bob, for that very generous and in some ways a sentimental introduction for me. I'd also like to express my thanks to the staff of the Media Studies Center and the Freedom Forum for all of their hard work in making this event possible. As I walked into the auditorium, I couldn't help but think back of my first job out of college as a reporter for the Berkshire Eagle. Although I spent most of my life on the street, I never lost my interest in the media. Roll Call was a particular love. I also started a series of magazines called Stage Bill and a number of community newspapers, and there's no better way, I feel, to get the pulse of a community than to be involved with a local newspaper. And through those experiences, I observed firsthand the indispensable role that the press plays in the democratic society. And now, in the job I hold, I see how quality financial news reporting brings emerging issues to our attention. It augments our actions and arms our market's most important constituent, individual investors, with the knowledge to make informed decisions. And by reporting on issues ranging from price fixing in equities to microcap stock fraud to the disclosure of mutual fund fees to the elimination of the hideous practice of pay-to-play in the municipal bond market, the press has made us all more responsive and more accountable, from the broker-dealer in New York to the fund manager in Boston to the government regulator in Washington. The press and the SEC share a broad mission, and that is to make available to the public vital, reliable, and timely information to help ensure that officials and institutions, whether they be public or private, fulfill their fiduciary obligations and to accept the responsibility for their decisions and for their results. And so I can think of no better place than the Media Studies Center to discuss the vital importance of transparency and disclosure, particularly as it relates to America's long-term financial health. In recent weeks, that's come into question. We've watched in awe as the perennial seesaw between bulls and bears has fallen and risen dramatically. And yet, despite the uncertainty that we are witnessing, confidence remains strong. Confidence certainly doesn't make markets rise, and it doesn't make markets fall. Confidence makes markets possible. Without it, they would be neither buying nor selling. There'd be silence. Someone once noted that confidence awakens confidence. It's the underlying reason why America's capital markets are as strong as they are today. Transparency, disclosure, and accountability aren't just catchwords. They are the essential ingredients to confidence. And without it, markets can neither sustain long-term growth nor can they adapt to a rapidly changing environment. In the current financial turmoil in Asia and in Russia, the word transparency has been used frequently. Transparency is critically important in a number of ways. For instance, it's an issue in how publicly a government considers policies, or how a company's revenue is derived and what its true expenditures are, or how a bank's loan portfolio may be constituted. For securities markets, transparency is the extent to which timely data and prices are visible and understandable to all participants, institutional and individual. At various times, some market participants have resisted efforts to increase the availability of information to investors. But experience has proven again and again that transparency, to borrow President Kennedy's words, is a tide that lifts all boats. Earlier this year, the SEC began reviewing the market for debt securities in the United States, with a particular emphasis on the state of price transparency. This morning, I'd like to report to you the staff's preliminary findings. I also want to discuss what steps I believe should be taken to help ensure that all sectors of the bond market are functioning as fairly and as efficiently as possible. Today, anyone who buys a car or a house or even a piece of fruit can obtain prices on identical or comparable items that will help guide their decision. But in certain parts of the bond market, you need a research department, you need a trading desk to discover such information. How many individual investors do you know that can afford those resources? The sad truth is that investors in the corporate bond market do not enjoy the same access to information as a car buyer, a home buyer, or dare I say it, even a fruit buyer. And that's unacceptable. Guesswork can never be a substitute for readily available price data. So today I am calling for increased price transparency in the corporate debt market. We're doing so for one simple reason. Investors have a right to know the prices at which bonds are bought and sold. Transparency will help investors make better decisions, and it will increase confidence in the fairness of the markets. Simply put, it's in everybody's best interest. There seems to be a common misconception that the bond market is somehow or other less important than the equity markets in America. But history shows that, if anything, the opposite is true. The bond market has played an important role in this country's development from the very first days of the Republic. The New York Stock Exchange, in fact, originated in 1792 as the bond exchange. For the first time, securities issued by the new United States government could be readily bought and sold. Those first government bonds funded the debt of the American Revolution. Treasury Secretary Alexander Hamilton not only helped create a new money supply, but he also linked the interests of wealthy bondholders to the fate of the new country. As American corporations formed and evolved, a market for the issuance of corporate bonds followed suit. Between 1850 and the early 1900s, railroad company bonds dominated the corporate debt market. Those bonds fostered the growth of more railroad companies than there are Starbucks in Manhattan. At the same time, an expanding number of public utilities and industrial corporations were also issuing bonds. Between 1900 and our entry into World War I, corporate debt tripled from $6 billion to over $19 billion, exceeding the federal debt. Bonds in those days were sold to a great extent door to door, literally door to door. It wasn't unusual for Wall Street bond firms to hire salesmen and to send them out on bicycles with a designated territory and a list of bonds that they had to sell. The salesmen would cycle to shopkeepers, to farmers, and even to country banks in the hopes of selling at least one bond a week. As equities came to dominate the New York Stock Exchange, the vast majority of bond issues, whether treasury bonds or corporate bonds, moved to trading on the over-the-counter market. I can remember when I first entered Wall Street that bonds on the New York Stock Exchange were traded in something called cabinets, and cabinet bonds was the word used to describe them. For most of the 20th centuries, bonds were considered, in the words of one writer, the staid province of high-quality borrowers and highly conservative investors and creditors. And as recently as the early 70s, most bondholders were still clipping interest in the form of coupons, mailing them in to be redeemed. I can never forget my mother, who was a school teacher for 38 years. When she retired, she purchased her first bond, and she would go to the bank where she kept this bond. She wouldn't trust it to the brokerage firm that I ran, and she and would meticulously tear out that coupon. And she grew older, I went with her, and that was a very important ritual for her. But simply put, bonds then were simply bought and held. This in part reflected the slow movement of long-term interest rates. Debt money, as Edmund Burke summarized in the 18th century, is static. For a good part of this century, in this country, Burke's statement rang true. However, with the onset of inflation in the mid-1970s, deficit spending in the 1990s, the debt market fundamentally changed in practice and in scope. Long gone are the days of bond sellers on bicycles. Global electronic markets, computer-based analytic services, and rapid fluctuations in bond prices are the order of the day. It's now a fast-moving medium that plays a major role in the American economy. The bond market affects all aspects of our lives, from the costs of building schools and building hospitals to corporate investment in areas such as plants and equipment. It impacts the assets of public and private pension funds. It channels capital to mortgage and car loans. It even influences revolving debt. The bond market also affects the prices in the equity market that all of us follow so closely. Just think about it. If you cannot value a company's debt accurately, how can you possibly make judgments that are sound about the equity in those companies? The bond market's economic significance is matched only by its sheer size. While New York Stock Exchange equity trading amounts to $28 billion per day, trading volume in all bond markets totals roughly $350 billion per day. U.S. corporate bonds outstanding have more than quadrupled since 1980. Municipal bonds have experienced similar growth. The total value of the bond market today is over $10 trillion, up approximately 400% since 1980. Some tend to think of the financial market solely as an equity market. These numbers should correct that impression. Our initial review of debt securities found that as a whole, the market for government securities is characterized by high-quality pricing information for investors. We are also confident that because of steps taken over the last few years, transparency is significantly greater in the municipal securities market. But we believe that in the area of corporate bonds, price transparency is simply not up to par. Historically, the debt markets have lagged well behind the equity markets in making price information available to investors and to the public. There are good reasons for this. The debt market covers a much wider variety of instruments and has been largely institutional. Nonetheless, the Commission on several occasions has acted to encourage market transparency. In 1991, with the encouragement from the Commission and Congress, GovPix, a 24-hour worldwide electronic reporting system, was formed to distribute real-time quotes and transaction prices for U.S. Treasury and other government securities. As a result, these markets now enjoy a higher level of quality price information. In 1995, again with the Commission's active encouragement, the Municipal Securities Rulemaking Board began collecting the details of dealer-to-dealer transactions in the municipal bond market and distributing daily summary reports. Just last month, with the SEC approval, the MSRB expanded its daily reporting to include customer trades as well as interdealer trades. Now, for the first time, investors, particularly smaller investors, have access to the prices and volume data of municipal bond trading between dealers and their customers. Our efforts simply will not stop there. I expect that these actions will culminate in immediate transaction price reporting, making the municipal bond market as transparent as it possibly can be. It is now time for the corporate bond market to step up to the plate. The need has never been more evident. These days, bond dealers don't need bicycles or even telephones. Everything is simply at their fingertips. Technology is revolutionizing how business is being conducted, but the corporate debt market remains one of the last major markets in the United States not to have some kind of electronic price disclosure system. I think it's fair to say that the recent volatility in the markets underscores the need for greater price transparency in this market. While everyone is familiar with the activity in the stock market on August 31st, most are probably unaware that there was virtually no buyer interest in the corporate bond market that same day. This lack of liquidity was readily apparent to the professional trader, but it was absolutely unknown to the general public until reported by some of the press the following day. What was not broadly reported, even after the fact, was that the pricing of high-yield corporates has been very, very difficult during this period. This can have a significant impact on a well-defined segment of mutual funds, those whom invest in this high-yield market. Now, I'm not suggesting that we transpose and create a national market system built the same kind of system that was built for equities to the debt markets. I think for lots of reasons that simply wouldn't work. But it's time for this segment of our market to catch up with the times, to catch up with technology, to address the lack of price transparency in the corporate debt market. I have called upon the National Association of Securities Dealers to do three things. First, to promptly adopt rules requiring dealers to report all transactions in U.S. corporate bonds and preferred stocks to the NASD, and to develop systems to receive and redistribute transaction prices on an immediate basis. I'm pleased to report to you that the NASD is moving forward on all of these recommendations. I think this is an extremely important step. These actions will likely result in a higher level of price transparency for the corporate debt market than what currently exists even in the municipal market. And with the strong improvements the municipal markets have undertaken recently, I think that this is no small accomplishment. I hope that in the near future, corporate securities will no longer be lagging, but rather leading in the pursuit of greater price disclosure. As I stated at the outset, we believe that overall the bond market functions effectively. We did, however, find certain sales practices that we find troubling. First, I am concerned that certain mortgage-backed securities are being sold to individual investors without those investors fully understanding the risks involved. It's likely that many individual investors are not even aware of the variables that influence the return or the duration of their investments. I'm principally, of course, referring to the sale of collateralized mortgage obligations, or CMOs, issued by either a federal agency or private corporation. A CMO is a bond backed by a large pool of home mortgages. These are complex financial instruments. Even professionals require sophisticated analytical tools to evaluate them properly. I doubt that many individual investors realize precisely what they've purchased. I'm also very troubled by reports that brokers may be marketing only the higher risk classes or tranches to individual investors, while lower risk classes are being sold to more sophisticated institutions. Second, we found anecdotal evidence of the possible misuse of inside information in the high-yield market. We were told that investment bankers and institutional investors who buy high-yield corporate bonds sometimes participate in syndicated loans for those same corporations issuing high-yield debt. These participants in syndicated loans are entitled to send representatives to regular meetings with the borrower's management and bankers. That's fine. But if confidential information from internal discussions in these meetings is being used improperly or leaked, affecting the prices of these companies' bonds, that would be unacceptable. As I have said time and time before, insider trading, whatever its form, is plain and simply wrong. These matters are now under investigation, and you can be sure that if we discover abuses, we will be quick to take firm action. There is very little doubt that the debt market is vital, that it has experienced strong growth, and in many respects is the backbone of corporate development in this country. But these facts by no means can guarantee its future prominence. The imperatives of globalization and rapid advancements in technology have put an absolute premium on information. Governments analyze and respond to it. The press reports and editorializes on it. Companies sell it, markets act on it, and investors rely upon it. Today, market information moves with the speed of light. The availability of accurate information to ensure the long-term stability of our markets has never been more important. The corporate debt market is not immune from these realities, and I think it folly to think otherwise. I simply refuse to accept that this market cannot be as transparent as others. That logic runs counter to the values of trust, accountability, innovation, and confidence that have been the hallmarks of America's capital markets. Cicero once wrote that nothing so cements and holds together all the parts of a society as faith and credit. But faith and credit are not simply arrived at through terms on a piece of paper. They are painstakingly forged over years in the day in and day out practices of a society. The American experience proves that public disclosure is not just a theoretical practice, but it's a living principle. Everyday practices, whether in government, the media, academia, or finance, when they are examined through the public lens, attain a measure of veracity and probity that would not exist if they were conceived in the veil of darkness. Transparency, both a means and an end. It plays a fundamental role in making our capital markets the most efficient, liquid, and resilient in the world. At the same time, transparency is a goal. We know from our own past experience and from the current situation in Asia and in Russia that there is a direct, a specific relationship between information and investor confidence. Increase one and you increase the other. Decrease one and you decrease the other. This isn't rocket science. The choice is clear. If we continue to be vigilant in the dissemination of market information to all investors, our nation's markets will remain the envy of the world. You can be sure the SEC will do its part, and we will expect our markets to do the same. Thank you.
Thank you, Chairman Levitt. We welcome our audience to join us in the annex on the other side of the gallery for continuing dialogue and discussion with the chairman. Thank you.